I think in terms of asset allocation, our view over the next sort of 6 to 12 months is to sort of have more into fixed income because the yield are a lot more attractive than they were before. And we see empirical evidence, at least in the US, that we're close to peak inflation. It doesn't mean peak interest rates or a Fed pivot in terms of cutting does.
Right, and that's really important.
That's important.
Right? That's what everybody else is looking at. Right.
So, but it means that you have a source of carry and yield that are quite interesting.
When we talk about the difference between consumer prices and price shocks from commodity world, there's been a difference there. We talk about volume versus actual CPI. How do you see perhaps China also playing into that? There's clearly a lot of uncertainty and indecision at the moment, it seems, around whether or not large parts are remaining in lockdown or whether or not this is the beginning or is the reopening of China. The implications there for growth and also for commodities demand, presumably that also is something that sort of feeds into the economic picture. How do you see things?
This is a very good point. There are two forces and two very important themes. So the first one, when it comes to China, was the zero COVID, zero tolerance when it comes to COVID policy. And this has led to, if you look at copper, aluminum prices down 20% year to date because of the concerns around the real estate market, because there's a lot less demand and a lot less sort of building and construction going on compared to the historical trend. As China reopens, then that could create a sort of increased demand, and you could see a pickup in demand for commodities. And that's an important element to bear in mind, because China has historically been exporting deflation or disinflation through cheaper labor workforce or labor supply, let's say. And now you could see a period of China potentially exporting inflation again. The other very, very important theme is really around greenflation and the energy transition.
Green with an N rather than a D.
Exactly. Not
okay, so we go from greed to green.
Greedflation. Okay. Greenflation. And this is very important because it's a multi-generational theme. Because if you think about the Biden inflation fighting plan or the European Green Deal, there is a need for significant amount of commodities to build wind farms, solar energy, etc. And this will require a huge amount of commodities and energy at a time when a lot of these mining companies and energy companies are being forced to reduce their capex and investment because of the negative environmental impact in terms of carbon footprint of their activity. So we are essentially in a situation where we have constrained supply with significant amount of demand. And this, according to Isabel Schnabel, who's a member of the ECB board, could lead to a period of sustained inflation, at least in the medium term, as the economy sort of switches to a more renewable world.
So for this, the longer term outlook does sound as though, we could still be in a period of inflation, maybe an inflationary regime longer term. We think, and people often draw the quick and perhaps slightly lazy comparison, as I'm about to hear, of looking at the 1970s as the last proper chapter or most recent decade of inflation. It sounds to me as though there could well be these the risk of recurrent inflation shocks if we are now in an inflation regime. Assuming that the Fed or a recession does get inflation under control in the near term, or near to medium term, how does this sort of play out in your view when it comes to, again, just bringing things back to this perhaps middle ground, if you like, where it's not peak inflation and it's not equally, rates going high forever. How does this sit with your thesis?
I think it's really a question of the shape of the peak of inflation. So if you remember in 2020, we were all using these alphabet soup letters, whether we'll have a U-shape, L-shape, V-shape recovery. I think today the big question is putting all these things upside down. Are we going to have an inverted V-shaped recovery, which is what the market was starting to price, and this is why we have a pretty strong rally, expecting the Fed to pivot? Or is it going to be more of an inverted U or inverted swoosh, where inflation plateaus and then takes time before going lower? In our opinion is that we'll see an inverted swoosh, because the Fed and central bank will have to keep interest rates higher for longer to bring inflation from the 6-7% down to the 2-3% target that they need. So it's very difficult to sort of assume this is a mission accomplished and job done when you start to see the inflation plateau, because to bring it down, you need a lot more tightening than what has been accumulated thus far. So our view is that that there's essentially more pain down the road and more tightening required. And then they might also be considering quantitative tightening as well. And we sort of tried that in the UK and didn't really go down very well in terms of financial stability. But I think, yeah, it's not an environment to necessarily go aggressively into risk assets.
You mentioned the UK there briefly, and without getting too far into the weeds of exactly what went on there, it's plenty of coverage and it's still a mess. Do you think that there's some potential policy divergence or just some difference in communication at the moment between, for example, the UK, the Bank of England, and the Fed? As you were speaking, I was thinking of what your views may be on the terminal rate, so where things end up, without necessarily putting an exact number on it. Whether or not it's a case of focusing on where the terminal rate ends up versus the pace of things. And the dichotomy, the difference between the two seems to be the Bank of England is suggesting that the terminal rate's not going to be so high, but the pace is going to be fast. So we're being steered towards focusing on the pace of tightening rather than the terminal level of rates. Whereas in the US, at least after the last FOMC meeting, of course it's changing all the time, but after the last FOMC meeting, Jerome Powell was very clear, he was explicit in saying terminal rate is probably going to be higher than you expect, but this is the ambiguity here. We may hike slower now than increase slower than previously expected. So in that scenario that we've just laid out, in terms of inflation perhaps being more persistent, the sequencing of how we get there, do you think this is a point where we go more slowly towards a higher terminal rate, or we're kind of pricing fairly where the terminal rate is? It's more a question of the pace.
So I think this is an excellent question. I think the Fed is fully aware of the lag effect between monetary policy, raising interest rates, and its impact on the economy. And this is why they've been talking about reducing the pace of the tightening, but not necessarily the end of the tightening cycle. Sort of to paraphrase Winston Churchill, it's sort of the end of the beginning versus the beginning of the end of the tightening cycle. And I think that we'll just need to see the incoming data over the next sort of few quarters to see whether inflation is really plateauing or whether it is essentially more inflation volatility. But I think it is fair to assume that the worst is behind us to some extent, and therefore, in terms of asset allocation, the 60-40 portfolio, which by the way died 7 times but was reborn 8 times, that was sort of a joke that I had with a client. Because as you saw historically, we have sort of volatility when it comes to the equity bond correlation, but over time, as I was mentioning earlier, there are automatic stabilizers, and that negative correlation sort of reassert itself over the medium to long term.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.